Hey, welcome to our webinar today on note investing in IRAs. We're going to talk specifically more today about what to look for in a profitable note. We have Patty Ped with Ader Financial today that's going to talk about that specific topic, is really what to look for. If you're a note investor, you're looking to get into note investing, what to look for and in order to make that profitable note investment. I'm the moderator for the seminar tonight and the webinar. My name is Scott Maurer. I'm a Director of Business Development for Advanta IRA. I've been with the company for a number of years now, primarily helping people get started with a self-directed IRA and also helping them make investments within their particular IRA account as well. I've been teaching classes, though, for a number of years in the self-directed world. Now, Advanta IRA, again, we're kind of hosting the webinar. We have happy to have Patty on tonight as well to talk about her expertise. But we are a self-directed IRA plan administrator. We work nationwide, and we provide exceptional customer service and experience for the self-directed IRAs that we administer. And in doing so, we have over 20 years combined experience in the industry. We currently hold over $700 million in assets. We have number of CPAs and attorneys that we work with. We have an account manager system as well. For every client that signs up with Advanta IRA, they are assigned one particular individual who will help them regarding their account all the way from the time the account is opened through all their investments and anything they need regarding their account. We also are very committed to education. As such, we're hosting this webinar and having this webinar tonight. We believe that an educated client is typically a happier client than those other individuals we work with, and we like to provide a lot of knowledge, whether that's a live webinar like tonight, or even the recorded, if you're watching the recorded version of the webinar, live seminars. We host networking events as well, and even lunch and learn events at our local offices in Atlanta and Tampa. We have a lot of free videos on our website, on our Advanta On Demand YouTube channel, and we post a lot of blog articles as well. Now, as we go through the presentation tonight, if you have any questions, either for myself or for Patty, please don't hesitate to type your questions into the chat box on your screen. If you're listening to the recorded version, just jot down your question, and both Patty and I's information will be given out during the presentation if you want to reach out to us separately with a question. Now, again, at Advanta IRA, we hold self-directed IRA accounts. And kind of why haven't people heard of self-direction? Very simply because most brokerage firms and banks, which hold IRA and hold retirement accounts, do not allow for individuals to invest in assets outside of the products that they sell. So a brokerage firm sells mutual funds or sells stocks. They don't allow for investments into true alternative assets. So we're going to talk about notes tonight, real estate, other types of assets as well. Now, the types of accounts that can be self-directed, any type of IRA, if an individual has a traditional or a Roth IRA, or if they're self-employed and they have either a simple or a SEP IRA, those accounts certainly can be placed into alternative assets like what we'll talk about tonight. So as long as you have an account, the designation, you look on your account statement, it says IRA, those monies can indeed be used as well. Education savings accounts and health savings accounts are not retirement accounts per se, but they follow the same set of rules, and you have the same investment possibilities with those accounts. They can also be self-directed. And any former employer's plan, and that's really important. People work for different companies. They work for the government. They build up 401ks, 403b plans. As you have those types of investments within those particular plans, when you leave those employers, that money also can be rolled over into a self-directed IRA. Now, as far as some of the types of assets that we see at Advanta, we're going to focus tonight a lot in talking with Patty about paper assets, people investing their IRA into mortgage loans, tax liens, unsecured notes, assets that are not a physical building, because a lot of people do use self-directed IRAs to buy actual property, but for other investors looking for more passive investment or more hands-off investment, you can invest in paper, basically your IRA owning that mortgage loan or that individual promissory note as the investment in your particular IRA account. Now, if you're starting a self-directed IRA, it's easy to get money moved from either an old 401k or an existing IRA by either doing a transfer or a direct rollover, which is just a mechanism to move money from the current account that you have into a self-directed IRA. It's a non-taxable, non-reportable event. There's notes you can move as much or as little as you want from one IRA to another. And in most cases, that's done fairly quickly. Usually the funds are transferred within a week or two. And then going forward from there, it's a matter of getting your investment made for your self-directed IRA. Now, again, in private lending, which is an arena that we're going to talk about and focus on tonight with Patty, IRAs can invest in a wide variety of different types of notes, whether it's a traditional mortgage loan that people would more associate with maybe their personal residence, shorter-term transactional funding, unsecured promissory notes, equity participation, secured notes, assets other than real estate, whether it's farm equipment, automobiles, livestock, can also be the collateral for a loan held inside of an IRA account. Now, when you're lending money from your IRA, if you're doing a direct loan to an investor or to a borrower, I should say, all the terms that go into making that note, the amount that's going to be borrowed, the interest rate, the length of term, is there any prepayment, is there any equity participation, et cetera, all of those terms are between you and your borrower. You're in charge of your IRA, and setting those terms with your borrower is up to you. Now, I'm sure, as Patty will talk about, if you're investing in certain notes that they may help you find at ADER, some of the terms may have already been set, but you're as the self-directed IRA owner, if you're using your IRA to do it or even doing it personally, you're in control of deciding kind of what terms are going to be acceptable to you in order to make that particular investment, or if you make that particular investment. So really the benefits of private lending, again, IRA or not, is you sitting in that banker's chair, acting as the banker, determining what terms you're willing to accept for a loan in order to lend your money out. So you're setting the rate at which your money is growing, whether it's in your IRA or not. And for a lot of individuals, it's the fact that investing in private lending is a very passive activity. It's less liability than owning real estate directly. There's usually less work involved, less headaches involved, not dealing with tenants and toilets. So it's a very low-maintenance asset. You have the flexibility as well to partner your IRA and other people's money or even your personal funds into these various investments as well. So if you want to learn more about self-directed IRAs, I'd encourage you to attend maybe a different webinar that we have at Advanta. We're going to focus tonight more on what to look for in investing in a profitable note. So at this point, I'm going to bring in Patty with ADER Financial, let her take over and share her guidance on, again, what to look for to invest in a profitable note. Patty, how are you doing tonight?
Good, thanks, Scott. How are you?
Very good. Well, I'll let you pull up your screen and go with your slides. And again, if anyone has any questions as you're listening to the webinar, please type those into the chat box on your screen. We'll make sure we get those answered either by Patty or myself.
Okay, great. Thank you, Scott. Are you able to see my screen and my slides?
Yep. Yes, I can. Yeah, it's right up in front.
Perfect. All right, great. Thank you for joining us today, everybody. My name's Patty Ped. I'm with a company called ADER Financial. And today, this is webinar part 2 of the webinar series, and we're going to talk about what to look for in a profitable note. Just a little disclaimer here, the material available here is for informational purpose only, and we are not providing any kind of legal advice. You should always contact your attorney for any financial advice that you need. And this also does not constitute an offer to sell or solicitation of an offer to buy any security interest or any other offer. Okay, just a little bit of background about ADER Financials. We are a nationwide private mortgage investment company. We deal mainly with distressed mortgages, or what we call notes. We are privately funded by our investors and our joint venture partners. We offer a very high level of service and flexibility in all of our dealings. We work with a power team, mainly the investors, the banks, realtors, and attorneys, and a bunch of different people that I will be talking more about in the next few slides. And we try to create win-win situations for everybody that's involved, which includes the bank and the potential joint venture partners, and most importantly, the property owners. Our mission is threefold. We achieve high returns for our investors. We also want to offer our homeowners unique solutions for all of their mortgage difficulties. And we also help lending institutions liquidate their non-performing assets. In today's webinar, we're going to cover some topics related to profiting from notes. Mainly, we're going to discuss what makes a note profitable and 10 steps to profiting from notes. And we're going to go into very much detail about the due diligence process, what to look for, where to look for that information, and how that is going to affect the value of the note that you are evaluating. We're also going to see how much it would cost for you to do this due diligence and how much it would be worth for your company in order to do this. And also we'll talk a little bit about what to do in order to be profitable in the note business. So let's jump right in and try to answer the question, what is a profitable note? There is no short answer for this, so let me give you the long answer. So there is no good note or a bad note. The only way you can look at a note is how much profit or how much yield am I going to get out of it, and how much am I purchasing it for. Now earlier, a few years ago, we would see notes at a very low price, being sold at a very low price, at say a $50,000 worth property, was the note on it was being sold, considering everything else checked out. It would sell for, say, 50% of the fair market value or the unpaid principal balance. But these days, the prices have gone up quite a bit, and we see notes in the market selling for almost 65 to 70% of the fair market value or the unpaid principal balance. Now, at this high price, it is necessary for us to do a lot of due diligence to make sure that the value of the note is intact and that there are no other liens on the property ahead of you, and all the other things that I will be going into detail in the next few slides. The market rents also drive the profitability on the note. I'll go into a little bit more detail later, but it ties into the monthly payments that the borrower makes on the note. So it is essential for us to know what the market rents are and what the market values are for the properties in that particular area. We also look at the foreclosure status. The profitability of the note also depends on the equity involved, if it's an equity or a non-equity deal. So think about it at an asset level. For each note, there is no fixed answer about what a profitable note is, but think about it for each asset, what makes this profitable or what reduces the value of this note. So the 10 steps, we talked a little bit about this on our previous webinar, so I'm going to go over this quickly. But in the first step, the property is sold to a borrower and the note is created usually by the bank, or if it's a CSD or contract for deed, by the seller. The note is then called a performing note, and then over a period of time, the borrower is steadily making payments and everything is fine. And then after a few months or after a few years, it may become a non-performing note. Now, non-performing is defined as something that is more than 90 days due. At this point, the seller may decide to sell the note to another investor or contact the borrower himself and try to do the workout. So if the seller does decide to sell it, they would then provide the note and the worksheet to a buyer for evaluation. And then step 4, we perform an investment analysis, or this is where the due diligence part comes in. This is the most important steps in profiting from notes. And it's also going to be step 8, which I'll show in a minute. But once you perform initial due diligence, you would then place an order, or you would place a bid, with the seller, and you would put in an offer price. So the next step is to negotiate with the seller as to why you think the value of the note is what your bid amount is. So the seller may come back with a counter offer of maybe a couple of $1,000s more, and then you may either accept the counter offer, or if you feel like the price or the value is not worth that much, you may counter back and say, give your new number to them. So this may go back and forth a few times, and then you would negotiate with the seller. You would also ask for other documentation about the note, like pay history, servicing history, any other documents, collateral files, a soft copy of them maybe, and any other files that the seller has on the borrower, any credit reports or anything basically that they can provide to you. And this is where your final due diligence is performed in step 8, where you would order the O&E report or the title report. You would have realtors, the realtors will drive by during the first, the step 4, but this is where you would perform the final due diligence and check the value of the note, confirm the accuracy of the information that was provided to you, the authenticity of it, and validate all of the data that you have received so far. Once you're satisfied with it, you would fund the deal, and the seller, you would be closing on the deal, and the seller would then transferring those documents, the collateral files and whatever documents we talked about in step 7, they would be sending you a hard copy of that to you. Now, this may take a few weeks depending upon how they have their collateral stored originally. Some of them use document custodian. Some of them have them, those files in their office. So it depends. The duration of this process depends on how the seller is set up and you are set up to receive them. And the last step is to board the loan with your servicer and start borrower contact and borrower management and start the collection process. So we're going to go into detail now about, and step 9 is where the typically where the IRA investor would fund the deal.
Hey, Patty, before we jump through, we actually had 2 questions pop up. So I want to make sure we get those answered maybe as we go along. And again, encourage anyone else who has one to ask them. Someone said, what kind of title issues are typical with notes?
That's a good question, actually. So why don't I make a note of that, and then I have a slide specifically that talks about title reports.
Okay.
So I could answer that during that time, maybe?
No, yes, certainly no problem. And the other question, again, if this is also, we can also ask this one a little bit later too, but then questions, do IRS liens affect your note if your note is in first position?
Yes and no. It depends because in each state it varies. So that's where the title report also comes into play. And yes, again, so I'll be going into detail about that later in my title slide. So.
Okay, good. Yeah, and again, if anyone has any questions, just type them into the chat box and we'll get to them.
All right, great. So let's dive into step 4 and step 8, which is the most important part of this whole process, the due diligence process. When you receive a tape you would want to evaluate the tape in three main sections or aspects. So when I say a tape, that is what information is sent by the seller. It's usually in the form of Excel, but if it's a bank, they may not have it in a concise and Excel format. But if you're buying from hedge funds and other investors, they may just send you all of that summary information in a single spreadsheet. So that's what is called a tape. And sometimes the tape may only contain one note if you're buying direct from a small bank, community bank, or you may receive 100 to 200 of them in a single tape. But when you receive it, you would look at three main things. The first is about the loan and what it entails, what the UPB is, and I'm going to go over it in detail next. The second thing that you would look at is the property, the address and where it's located and what the property is. It a single-family home or what type it is, and that kind of thing. And the third aspect you're going to look into is who the borrower is. So let's talk about loan. When you see the tape, the first thing that you would look at is the unpaid principal balance or the UPB on it. This may be a driving factor or for the bid amount or the bid price, or it would be the starting point for your bid. Most sellers usually tell you how much they're expecting for this loan based on or a percentage of the UPB on the loan. They may just say we're looking for 60% of the UPB or 50% of the UPB. So this is something that you would look at the first time you're looking at the tape. Then you also need to know what the original principal amount on the loan is, which sometimes, in some rare cases, the unpaid principal balance may be higher than the original principal amount. Nothing to worry about. All it's saying is that at some point, the borrower may have had a workout agreement written with any of the previous lenders or owners of the note previously, where they either had the arrears attached to it, attached or added to the principal itself. Usually it goes as a balloon payment, but sometimes it also gets added to the actual principal. So that may be one of the reasons why you're looking at a higher number there. And the next thing you need to know is the note origination date. You need to know what date it originated and what the principal amount is, so you can go back and look at the deeds or the mortgage records and verify all of these amounts there and identify your loan from there. Then the paid to date is also very important because that helps you calculate your arrears and what the final payoff may be. And it also helps you calculate if the note has passed the statute of limitations or not. I'm going to talk about statute a little later. And then you need to know when the next payment is due. The payment the last payment made may have actually been, say, 6 months ago, but the actual payment was for, say, 2012 April. So you need to know what dates the actual payments were made versus what dates the payment was due. And of course, you need to know the interest rate on the loan. And you also need to know the current monthly payment. How much is the borrower currently paying for this loan? Now, for non-performing notes, even though the borrower is not currently paying it, you would still call it current monthly payment because that's what they're supposed to pay every month. This is also a good indication when you compare it with the rents that would be a very good deciding factor for you to choose which exit strategy would make more sense here. For example, if the current monthly payment is more than the rents in the area, it means that the borrower is better off taking or going out of the house and getting his own rental place. So he would not be interested in paying such a high monthly payment to you. Instead, he would just rather rent an apartment somewhere else. But in case the current monthly payment is lower than the the rent, that means that you have a negotiation tactic, or you can say to the borrower that, hey, if you had to move right now, you would be paying much more for your rent, so you might as well just start paying the current monthly payment. That may be easier on you to do that. So that kind of gives you an incentive, or that kind of gives the borrower an incentive to start making the monthly payments. So that's where the monthly payment actually is useful to understand. And then statute of limitations, I mentioned this when I talked about the paid to date. The statute is very important to understand because in each state there are different rules about the statute of limitations on the note. On a promissory note, for example, Florida has a statute of limitations of 5 years. If the last paid date, now today is November 8th, so if the last paid 2017, so if the last paid date was, say, August 2012, 5 years have already passed. So the note now is out of the statute of limitations. Now, this doesn't mean that you can't still go after the note and you can still get the borrower to pay you, but if you know that the statute of limitations has passed, you would have to contact an attorney and have them review what the terms of the note were so that they can help you for that particular state how to deal with it. For example, in some states, you can still collect on the note, but you wouldn't have the right to collect on the arrears for the remaining years or the remaining term. In some cases, if you haven't touched the borrower in the past 5 years, you can't go back and start harassing him now. So there are different rules in different states, so it's important to know what the statute is and then contact an attorney who could help you identify state-specific requirements and guide you through the process. Now the next one is payoff. Many sellers may not give you what the actual payoff is, but if you have a copy of the note, it may be easy to calculate. We do have some arrears or arrear calculators that tell you what the interest rate is and what the grace period is and what the late fee is, that kind of thing. So using that information, you may be able to calculate the arrears and the payoff from it. You also need to know the names of the borrower and the co-borrower so you can perform further due diligence on them. Now the next part is about property. When you have the property address, the first thing you would do is to go on to Metro Online. Actually, that's my next slide, I think. Okay, I have that in the next slides, but the first thing that we do usually is just Google it and see what comes up. Sometimes it may say it's in foreclosure, like Zillow and Trulia usually tell you if the property is in foreclosure. The title report, the first one that I have here on the list, this is something that you would do in step 8 rather than step 4, because this would actually cost money and you wouldn't want to spend the $125 or the $100 that it would take for the title insurance if you're not sure if you'll actually end up purchasing the note or not. So I would reserve that for step 8 rather than step 4. But I will be going into detail about the title report in my next slide, so I'll just move on to the next one. You need to know the occupancy status because that could again drive your exit strategies. If the property is occupied, you can most likely look into loan modification if the borrower intends to stay in the property. If the property has been vacant for a while and the owner hasn't been living there, the most likely scenario would be that it would either be a deed in lieu or a foreclosure on that, and the borrower may be willing to walk away from the property and sell it to you. So that's one of the reasons why you need to know the occupancy status, and it also tells you a little bit about the property condition also. If it has been vacant for, say, 5 years, you know that it's not going to be in a great condition. So that's why you need that. And then ownership, you need to know, once you check on the county website who the current owners are, it may be completely different from what you see as the borrower's names sometimes. So it is very crucial for you to validate the owner's names when you do your due diligence. If you go on the county website, if you look up their taxes, you would have the full address, so you'd be able to look up their taxes, and it would tell you who the current owner is on the website. And utilities, here's where you have to actually pick up the phone and call the utility companies and ask them if the water or the electricity or whoever you're calling is currently switched on for the current property. That may also help you validate the occupancy status of the property. If you know that there is no power, there's no water, and nobody's been paying the bills for a while now, you know that it has been vacant for a while, and you may be able to define what a while is. The next thing is one of the most important, the value of the property. This can be done by either requesting a BPO on it, an actual, like you could purchase a BPO, or you could also talk to a local realtor. You could just go up on Zillow and put in the zip code, and that would give you a list of realtors in the area. So you can give them a call and say, hey, I'm looking at this property. I'm not going to purchase the property, but I'm looking into the mortgage on it, and we're looking for some long-term relationship with some realtors who may be able to help us by driving by the property and giving us certain information, which would be the 30-day quick sale price of the property, what the property condition is, how the neighborhood is, if it's a seller's market or a buyer's market, what the rents are like in the area, how much it would, once they know what the property looks like, they can tell you how much the repair cost would be. They can also tell you how much the after repair value of the property is. They may also be able to confirm the occupancy status of it. They may see a couple of cars parked outside or some lawn chairs or something that indicates that there are people living there and it is currently occupied. They can also help you by taking pictures of the property, drive-by pictures. Please note that all of this is going to be exterior only because you have no right to go into the property or contact the borrower before you purchase the note. So make sure you or your representative is not doing that. So they can, once you see the pictures, you can get a sense of what the property looks like, how it's being maintained, and how much pride the owner has in the property, and how much emotional equity is in the property. And the next one is looking at taxes and insurance. So if you go on the county website, if you enter the address of the property, it should be able to pull up the current tax information for the property, if it has been paid or if it has been delinquent, when the last payment was made, and what the late charges are, and all of that information is for free. It's readily available on the county website. Same way, you can also look up any liens on the property. You can also, typically you'll know if there's an HOA on it, but most likely the other liens, the municipal liens, and then the HOA, and I know somebody asked about the IRS liens. All of this information would be available in the title report that you would order. The location and comps, we just covered this. The realtor would be able to give you that information, the property condition, and based on the property value, you may be able to calculate the equity on it based on how much is owed on the first mortgage versus, or if you're purchasing a second mortgage, you can calculate how much the property is worth after their first mortgage. And then pictures and market growth, I mentioned, we talked about this. The realtor may be able to tell you what the market looks like and how much growth you can expect. So here comes the most interesting part, the title report, or it's called the ONE, or Ownership and Encumbrances Report. So the title is a document of record relating to the subject property. So every property is tied to this title, and unless you have a clear title, it's not advisable to go in or jump in and purchase the note because sometimes it may take a few weeks to a few months before you can get a clear title, and sometimes you may not even have a clear title after the end of all of that. So it's very, very essential for you to get a title report before you close on the deal. What does it tell you? It tells you the lien position for the lien that you are purchasing now. The priority of the lien would be by the date it has been recorded in the county office. So a first mortgage may actually be for $20,000, and a second mortgage may be for $60,000. I'm just throwing random numbers out there. But it's not the amount on the mortgage that decides the lien, but it's the order in which it was recorded in the county office that tells you which one has a higher lien position. And not just the position, but it also tells you if there were any subordination agreements written meanwhile, or if there was any renewal or an extension of these agreements within the deed of trust. It will also tell you if there was a lis pendens filed by any of the previous lenders and what the status is. A lis pendens is a term used for a notice of default in judicial or court states. In non-judicial states, it's called a notice of default, and these are recorded with the county, and these are an indication that the foreclosure process has been initiated on a particular property. So once it has been recorded, you now have proof that one of your previous lenders has filed this. So you can now go back and look up this information based on the case number. You can look up this case and you will get information as to where it was when it was canceled, or if it's still in process, if it was canceled, why it was canceled, or if there was a sale date that's coming up in the next few weeks. So all of this information would be included in that. And then any judgments that have been placed on the property or on the borrowers. And if there is any debt of the borrower or the co-borrower, the title report would also capture that. Coming to adverse liens, any IRS liens or state tax liens would also show up on the report, and it would clearly state, or there would be a comment section there that would state what the position is and what the effect of that is on your note. In some states, now this is entirely dependent upon the state, but in most states, the tax liens and the IRS liens take precedence over the mortgages. So when you buy or when you purchase the note, you would first either pay off the tax liens on it or the IRS liens on it, and then you would either foreclose on the property and that would be your exit strategy to get the money from that, or you could try to do a workout with the borrower where you would include that money in the negotiations going on. So IRS liens and state tax liens are very important, and when you are trying to evaluate the value of the note, you would try to find out how much or the dollar amount on these, and you would deduct that amount from your profits so that you can adjust your bid based on these numbers. Because this is something that you cannot avoid and you have to end up paying. Coming to property taxes, again, this is kind of tied into the tax liens. Not all property taxes are tax liens. There are specific property taxes that the county decides to sell at a tax sale every, it depends on how they're set up, of course. So if the property taxes have been sold, there would be a tax lien created on it. But if it's not, it would still be delinquent taxes, and you would still have to pay the county for it. So when you're doing your valuation of the note, you would definitely have to include how much property taxes are due and subtract that amount from the profits that you're expecting. And the utility liens, HOA, in very specific states, the HOA is also called the super lien, and that has precedence over all of the other liens. So that's also something that you need to look into or talk to an attorney about before you purchase a note, so you know if the HOA lien supersedes your lien or what you need to be prepared for.
Yeah,
now,
Patty, if I could just interject again, I just want to,
sure.
obviously the people, we got those a couple questions answered, and encourage anyone else to ask any more that they have. I haven't seen any come up, but we probably have about 20 minutes or so. If anyone has any questions, just make sure to get those typed in.
Absolutely. Okay, and the last and equally important aspect is the borrower. If you're purchasing a second mortgage, or even if you're not, it is nice to have if you're purchasing a second mortgage, it is very, very important for you to get a credit report of the borrower, because that would tell you a lot about the borrower, and especially about the first mortgage that they have, how regular they are with their payments, and how financially responsible they are, and all of the good information. Now, if you're buying a first mortgage, it's more like a nice to have rather than a necessity. If you have it, it would still provide all of the good information that you need, and it would still be useful for you. You also need to know about the borrower's pay history. Now, many of the banks do have that information, but the sellers may not, as it it may have come from bigger hedge funds, or it may have trickled down from the bigger fish. So you may not have the access to the pay history, but if you do, that would give you a sense of what the borrower's intent is, or if they're being responsible, and if they're actually trying to make their payments on time, but they've been missing just a couple of times, or if they're consistent in their late payments, or how the whole process is set up. And then skip tracing is where you would try to find out more information about the borrower. You may just Google the borrower's name and just see what comes up. You may be able to find out their phone numbers, their employment information, their many different things, actually. Sometimes even the relative phone numbers pop up when you do your search. So skip tracing is trying to get the most recent or most updated contact information of the borrower. You'll also know if their current address is something that has not been listed, or that is not the property that you're looking at. That is an indication that either the borrower has rented out the property, or he has moved on and the property is vacant. So bankruptcy status is very important, because that would tell you if your lien or your first mortgage exists or not. So this is a website called Pacer. It has all of the information. It's a national index for the U.S. District, bankruptcy, and the appellate court. So it has all of the cases, the bankruptcy cases, and sometimes the civil cases that have ever been filed in the United States. So if you look at the party search area where it says party name, if you put in the last and the first name of the borrower in here, I usually don't do exact matches only because sometimes the borrower you may know a short for, say, Jim, when his other name may be something different. So anyway, so it's good to have not have exact matches, so you have more variability there. So when you click the search button, it shows you all the bankruptcy cases that they have ever filed. And once you see the bankruptcy cases, you'll know if they have been repeat filings. You'll know what the borrower's intent is. You'll know if the bankruptcy is still active or not, or if it has been dismissed for some reason, or if they have been discharged. Now, the main difference between dismissed and discharged is that when the borrower is dismissed, it means that they may not have completed all the steps that were required by the bankruptcy court, or they may not have made their payments on time that they were supposed to. So that case, that is an unsuccessful case, and it has been dismissed. Now, when the borrower is discharged, it means that the borrower has been making successful payments all along, and they were successful in completing their bankruptcy. So all of this information you can find as you go into search and open up a specific case. You'll know the start date, the end date, the case number, what the status is, who the trustee is, who's helping them. And if you go further into the history of the documents, you'll also have something called the schedules. Schedules A to J, they talk about what the income of the borrower is, what the monthly expenses are, what they have to list all their property, everything that they own should be on it. The cars, the dogs, the jewelry, everything is on it. So that is a lot of information that you would usually not have access to if not for this bankruptcy case. So that's just because they're in bankruptcy doesn't mean that the value of the note has gone down. What it means is that if they have a monthly payment plan, again, this is dependent upon if it's a Chapter 7 or a Chapter 13. But if it's Chapter 13 and they have a good payment plan, you are now being paid by the trustee every month without fail. The money's coming to you. It's going to be a performing note most likely. So that's a good indication of how much profit you can expect from the note and how profitable you can or how profitable the yield is. And this was the website I was talking about a little bit earlier. So it's called Netra Online. Netra is, I think, nationwide and environmental title research company. So they provide information or links to each county. If you type in the zip code from the address that you were provided, if you type in the zip code and look up, it will tell you what county the property is located in. And when you click on the county, it will give you a list of these. You have links to the Register of Deeds. You have a link to the county treasurer. The Register of Deeds is where you would go to pull up the mortgage or the actual note or a copy of those. And then the treasurer's office is where you would go to find tax information, the latest, if they're current or if they're delinquent. And then the county mapping or the GIS would give you the dimensions of the parcel, and then you can validate the parcel number with the information that you have about the property. What else do you need to do due diligence on in order to have a profitable note? You need to know what the licensing rules are in each state. Now, some states, like Georgia, require that you have a license. Some states, like in Florida, you don't need a license and anybody can just be a debt buyer. Now, there's two types of licensing, a debt buyer license and a servicer license. If you are using a servicing company, which I would heavily recommend, then you may not need a debt buyer license in many states. So it's important to know where you need the license and which of these states are profitable to you, which ones have more notes coming in every month, which ones have more foreclosures going on every month. So that's something that you need to know that would help you stay within the legal terms of the note business. And we talked about the statute of limitations. Once you get a note, if you see that it has been more than, say, 5 years due in Florida, you would have to talk to an attorney and ask them the right questions. You need to ask them what the rules are in Florida to collect on a note that has not met the statute of that has passed the statute of limitations. You need to know if it's a judicial or a non-judicial state, because that's going to affect your attorney fees and court costs. The attorney fees are usually 90% of the time or 99% of the time, they usually follow the Fannie Mae guidelines. So when you talk to your attorney first, you need to ask them if they do, and then Fannie Mae publishes the cost of or the attorney fee for foreclosures in each state, and I think it updates it every year. So you can just Google that, and that's what that would give you an estimate of how much it would cost to foreclose on your note, and that's the number that, and the court cost is also something that you need to know, something which is also available online for free. So the information, I mean. So that you would use these two numbers and add it to your total cost or total expenses for your note when you're calculating your profits from it. You also need to know your holding costs, how much you're paying your servicer every month. If you're using a special servicer, how much you're paying the special servicer to do this for you. If you have a document custodian, how much do they charge you every month? So you need to figure out how long you're going to hold the note for, or you may just calculate for the first year and then kind of calculate your first year as ROI based on that. But you need to know what each of these companies is charging you either every month or every year, and include that in your expenses when you're calculating your profits. Also, one other thing that you need to look at is hardest hit funds. They are available in multiple states across the country, and as you dig deeper, there are some websites for specific states that have a calculator on them. If you know enough information about it, you may be able to just look into the calculator and see if the borrower is eligible for hardest hit funds. So this is something where the government would pay you a certain amount of money and the borrowers a certain amount of money and help them out and help them get back on their feet in order to become current on their mortgages. So that's something that you may want to look into. Now, how much does all of this cost? It depends entirely upon what type of note you are purchasing or trying to purchase. If it's a secured or an unsecured note, if it's a first mortgage or a second mortgage, if it's a performing or non-performing, if it's in foreclosure currently, or if the borrower is in bankruptcy. Now, the two websites that I talked about, those are both completely free. Actually, no. So the PACER website for bankruptcy, this will let you register for free, but every search or every page from then on is you are charged about 10 cents. So, but the amount of information that you get from this is worth much more than what you're charged for this in here. So I would highly recommend doing this for every borrower that you come across, so that you know if there is no record of any bankruptcy at all, or if they do, you would know all of their income, expenses, and all of that wonderful information about them. And this website, Metro Online, is completely free. So you can just go online, and from here you have links to the Register of Deeds for the taxes, for the treasurer, and then the mapping website, and all of this is completely free. And it also depends on what the seller has provided to you so far. If they have given you all of the information that you need, you may not need to look further.
Well, Patty, are you there?
Hi, Scott. Can you hear me?
Oh, yeah, sorry. Yeah, you disappeared there for a second.
Yeah, sorry. I don't know what happened there.
Go ahead. You were talking about what the due diligence, what the seller provided?
Yes. So it depends on, sometimes your seller may actually give you copies of the BPO or the title report. So in that case, it makes it very easy for you to do your due diligence. If they have not given you the title report, It would cost you about $100 to $125. But I would say if you have done all of the other due diligence and you still want to proceed with it, I would highly recommend that you get a title report, because it would uncover any liens over the past 30 years that have been placed on it. And if there is no release of mortgage that they can find, it would notify you about that, and it would tell you that there is no release. So you can either contact the title insurance company or the actual lenders and have them provide the release documents to you, so that the liens on it have been removed and the mortgages have been satisfied. So how do we ensure that we are profitable in the note business? The main focus is to know the right people and to form a good power team. You need to have a team of realtors, of sellers, vendors. These realtors will most of the time they're willing to drive by the property for you for free and provide all of that greatly useful information to you. Now, in exchange, you don't want to waste their time. So in exchange, when the property actually becomes an REO, or when you become the owner of the property, the realtor would get to be the listing agent and the seller's agent for you, so that they can make a commission out of it. And then you need to have a good attorney or a trustee who can help you or guide you through the process of the foreclosure or any title issues that you notice on the title report, or basically any legal issue. For a fee, I think they can also review all of your collateral for you, and they can tell you if there's any missing links in the collateral, or if there's anything that needs to be fixed, or if there are any red flags, or if you need to stay clear of that loan before you get deeper into it. So having a good attorney or a trustee is very essential, or a very useful power member of your team. And then we talk about loan servicer. So we talked a little bit about this in terms of licensing. If you have a loan servicer, that may be sufficient in many states. These loan servicers not only accept payments from your borrowers, they also send them monthly statements, and if it's an ARM, they send them notices about their ARM, how the interest rate is going to change next month or next billing cycle. And they're always there to take any calls from the borrower, answer any questions. And some loan servicers also do the workout for you for the non-performing notes. They would help you convert them into performing notes. So it really depends on how much you want to do the servicing versus how much or how active or how passive you want to be involved in this. So there are a lot of good loan servicers out there, and once you talk to them, they will give you information about all of their services, and you can pick and choose which ones make more sense for your particular business, and go from there. The asset managers, again, excuse me, the asset managers are very helpful when you are looking for notes that other investors are trying to sell or other hedge funds are selling. So the asset managers can help you find notes or price these notes from if they're selling their own company's notes. They can help you price them and source these notes from other locations. And once the property becomes an REO, you would need property managers who can bring in tenants for you if it does become a rental. And then you have general contractors if they need to go in and make some minor repairs and maybe do some painting or anything like that. So you need some contractors who may be able to fix up the property for you and make it look nice for the realtor to show. The most important thing is to pick up the phone and start making calls. Many people want to be on the sidelines, and it can still be done, but the amount of information that you can get by actually calling the people involved, calling the utility companies, the realtors, the bank managers who may be willing to sell their loans to you. So it's all about making phone calls and trying to keep in touch with all of these guys, especially, and also with your vendors. How you respond to them, how do you interact with them also makes a lot of difference in how you make your profits. And then you have to do your research. All of this due diligence that we mentioned, the more you know, the better prepared you are, and the better knowledge you have in order to make decisions about your exit strategies. Always run the numbers and make sure you're looking at the accuracy, the authenticity, and the validity of all the information that you have received from the seller. You should trust your seller, but you should also verify and check that all your numbers are working out. And you need to be clear about what you want to do, what yield you're looking for, what rate of returns you want, what type of notes you want to do. Is it performing? Are you more comfortable doing getting monthly cash flow, or are you looking for one-time investment kind of thing? What states you want to invest in, what the rules of the states are, and what are most suitable for you, where you have good sources of notes. So you need to be clear about all of these things. And if you're not, again, go back, pick up the phone, and make calls. Talk to other mentors or talk to other note investors. Ask them the right questions, and you'll get all of the answers. And these are not, you don't have to set them in stone, and these are not going to be your purchase criteria forever. But it may be a good starting point to have these in your list and have them as you go along. And you can keep making changes to them as you keep hearing about other things, as you see market trends, and as you see more yields outside, as you keep learning more about the note business. But initially, it's nice to be clear about what you're trying to do so you know what to work on for the rest of the duration of your investment. The next thing is to vet your seller. You may be looking at different brokers who may be trying to sell you a tape or show you a tape that has been in the market for the past 6 months. That may be just going round and round from one broker to the other, and it may just have ended up on your desktop, say, just now. So the problem with this is, A, they are heavily marked up, and B, the seller or the broker doesn't even know who the actual seller is, and they may not even have all of the collateral or anything related to the note. If you needed any information about the note, if you asked the broker, they may take a couple of days to go through all of those layers and try to find that information for you, and sometimes it may not even get back to you. So these are called daisy chains, and it's best that you avoid these daisy chains because of the high markup and the less, I would say, lack of clarity in the transaction that is going on. So you always ask your seller if that is their own note that they're selling, or maybe they're just selling it for one other layer, but you may not want to go higher than one layer between you and the actual seller. And you also need to ask them if they have all of the collateral files ready, if you wanted a soft copy of it, if the files are, if you can actually view the files before you make the final purchase and put in your money into it. So there are a bunch of different things that you can ask your seller to make sure that they are legitimate and what they're providing to you is good information. And joint ventures are a good way to start in the note business if you've never done it before, or if you have capital that you are looking to invest. We usually see double-digit returns with all of our deals. We partner with individual, institutional, or mostly IRA investors, but usually rather than a pool of money, we usually do it on a deal-by-deal basis. So how this works out is that the investor funds the asset purchase and the workout costs, and we usually handle all of the asset sourcing. We do all of the due diligence, the workout management. We talk to the borrower. We do the borrower management, risk management, and ultimately we would sell the asset either to the joint venture investor himself or to other outside investors when it becomes a reperforming note or any of the other exit strategies that we use. So all of these, the proceeds or the profits would then be split between the joint venture partner and Advanta Financials. We work with both passive and active investors. The active investors also get a little bit of training as to what's going on in the business and how we're dealing with the attorney or how we're dealing with the borrower, what calls we've been making, and how the borrower's responding. So all of that information. So they get a little bit of training so that they can go back and start investing in their own notes, or they can either go back and purchase a note and then bring it back to us so we can do the workout for them. So there's multiple ways we can do this, and I talked about the high level of flexibility that we provide in how these are structured. We also provide detailed documentation about each of the deals. So the investor is it's a very transparent process. So the investor is able to log in or look into the shared folder and view all the receipts and all the collateral files and all the documentation that we have on the asset, so that they're always kept in the loop and they know what's going on at every step. So in conclusion, a profitable note, we just talked about what to look for and how each of these aspects affects the value of the note and what you should consider when you are looking into calculating your profits on each note. If you have any more questions, my email is patty@adafinancials.com, and my phone number is given here, and you can just contact me anytime, and I would be more than happy to set up a free consultation for you, a one-on-one consultation, and we could go over any questions that you may have, any note investing goals that you may have, and how Advanta Financials can help you with your goals. Do we have any questions here, Scott?
I don't see any coming up now right at the second, Patty. If anyone who's on has any additional questions, please make sure you get those in there. I guess maybe just so we give people a chance to ask a question, kind of, I guess, what do you think the most important aspect? I mean, I know you talked about a number of different things, but the most important thing for a new investor to consider when going in and trying to find a profitable note?
So the three most important things are value of the property, the taxes on it, and the title. So if there's no clear title, all of this work that you may put into it may become worthless. If you realize that when you run your O&E report, if you realize that there were 3 other mortgages ahead of you, when in fact you thought you were the first mortgage, then in case of a foreclosure, the first 3 mortgages are going to be paid even before you see a penny out of the foreclosure sale. So having a clear title is very important. I think that's one of the main things that you need to look at. And the other thing that we talked about was the tax liens. If there are any IRS liens or tax liens on the property, you need to know the amount on them so you can add that into your calculations when you do your when you try to find out what the yield is and what the profits are. And of course, the value of the property ties into all of this at a very great level.
Okay, yeah, we did have a question come in, and I don't know how familiar are with the state of Georgia, but someone said regarding the state of Georgia, this person was told that they can own up to 5 notes before they need a license. Is this correct? And I don't know if it's a matter of, maybe if you can speak to this or not, Patty, but is it a matter of owning the notes, or is it kind of originating as a direct lender? If there's a distinction, if you know the difference between those or and how that applies to Georgia.
I couldn't speak about the origination of the notes, but I can tell you about the owning part. So yes and no. It depends. Georgia has very specific rules. One of the rules, so typically you would need a license in Georgia, but one of the exceptions is that if you, as a lender, own less than 5 notes, and I'm not sure if this is per year or in total. I think it's in total, but again, you may have to check with an attorney on this. Then you could potentially buy a note in Georgia. Also, there is one other exception, but I don't know for sure if this is adding to the first exception or if it is an exception by itself. But this one states that the borrower or the property that you're looking at needs to be the primary residence of the borrower. It can't be a vacation home, or it can be a secondary rental home that he owns. So what I'm not clear about is if it has to be in conjunction with the less than 5 loans, or if it's an exception by itself. So you may need to talk to an attorney for more clarification on that.
Okay, yeah, and someone else had a follow-up on that. Do you know, or do you have a site that explains if you're doing private lending, do you need any kind of debt or service license for each state? Do you know of any particular website, or is that a situation where they need to pick a state and probably contact a real estate attorney?
So I don't, from my experience over the past few years, I don't think any attorney would be able to give you a straight answer of a yes or no if you ask them if you need a license in a particular state. The reason I know this sounds very vague, I'm sorry, but the reason is that it depends on how your company is set up also and what you're planning to do with the company. If you're looking to service your own notes, or if you're planning to contact the borrower, or if you're just buying it and having a servicer take care of all different pieces of it, or so there's multiple factors in here that are kind of hard to kind of standardize. You can't just say Florida doesn't need a license and Georgia does. So it depends on how your company is structured and how the note is structured and what you're planning to do with it also. So I think the best way for you to get access to that is, I think you can just Google like mortgage buyer's license or debt buyer's license and something might come up. But that's, again, very generic information, and it may not be applicable to your company and your scenario.
Yeah, and I know that there was some issues. We talked a lot. We've had a lot of people asking us just with doing lending from their IRA of the Dodd-Frank rules and how those have impacted lending. It's still, I don't know, kind of like you said, Patty, it's kind of vague, but I don't know if I ever got a really clear answer on all of those. So yeah, make sure that you do some research into it. You probably even contact the state themselves to find the right person in the right department at the state to find out when a license is needed for that as well.
And there are some third-party companies that do this also. Like they specifically deal with licensing for mortgage buyers and servicers. Like I know of a company, Cornerstone Support, and then there's Thomas Law Firm. So there's multiple companies where you may just give them a call and they may be able to, but they charge you, of course. They'll charge sometimes. I don't know about these two specific companies, but I've spoken to other companies where they said they were going to charge, say, $200 to $500 per state. And we were to give them a list of 5 states so they can evaluate how our company is set up and what the state rules are. And they can research that and tell us if we need license in those particular states. So it's going to be $200 to $500 per state to get that information. But again, others may be able to do that for a much lower price, or if you know what state you're looking at, it may be easier.
All right. Well, Patty, we don't have any other questions, and it was a pleasure having a webinar with you again. Some great information. So yeah, again, if anyone who is listening live, we appreciate you on the webinar here tonight, and anyone who's listening maybe to the recorded version, please contact Patty with some additional questions you have on investing in notes and profitable notes in particular. And as well, if you have any questions for me at Advanta IRA, here's my contact information also on self-directed IRAs. So Patty, again, it was a pleasure. We look forward to doing another one of these next month.
Sure. Thank you, Scott. Thanks for the opportunity, and thank you all for attending and for listening to us.
All right. Thank you. Bye.